Alibaba reported Q3 2023 results, and the market is not reacting pretty well to it. And so let's dive into exactly what's happening. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now this is kind of crazy because I didn't really think that the results were that bad that were released, and they gave us an indication that things were starting to pick up and sort of like turn around post February or mid-February. But however, notice that they did open at around $100 per share when they released results, and by nearing the end of the day they closed at 94.16, which was the previous close. However, in pre-market, as of the time of the recording of this video, the stock is now down closer to $91, and it's very likely that it could drop under $90 per share in the next trading day. So that's a full $10 per share decline in just one day on what I would think would be pretty, I wouldn't say they're like exceptional results, but the idea really is that things are starting to open up, things are starting to get better. And so what's weighing this whole thing down? I think a lot of people are worried about competition, and a lot of people are worried about a sluggish global economy because we are hitting higher inflation numbers. And so they're expecting that, there might be a need for higher interest rate increases. And so that just throws everything out of whack. And of course, it brings to light one of those major risks that I was highlighting earlier this year, which was that what happens if there's a global slowdown to the Chinese economy? At the end of the day, they are the world's factory. Well, if the world is not consuming, what happens to the factory? It gets shut down. And so I think that's really the risk here. However, there could be an opportunity if the share price drops low enough. That's the way I'm sort of like thinking about this. And so let's dive right into the analysis. So, I mean, the three things that stand out in this quarter is one, China commerce remained impacted from the lockdown. So you can see that it went backwards in the quarter by 1%, and year to date it's gone backwards by 1%. Mind you, that has outperformed my expectations. I thought China commerce was going to do much worse, 5 times worse actually. I thought they were going to be down 5% this year, and so the fact that they're only down 1% is a real outperformance relative to where I thought they would be at the beginning of this year. Cloud has continued to stall, and so let's see how this plays out. In fact, the last quarter, this most recent quarter, is actually worse year-over-year growth than we've seen on a 9-month ended basis. And so let's see how this plays out. They did spend a lot of time talking about cloud, and so I remain somewhat optimistic. However, I did bring down my cloud growth expectations on second review when I started doing this full analysis. And finally, the promises that Tony Zhu made about profitability have materialized in a big way, and you can see the profitability on roughly the same revenue has jumped up substantially. And so that's another theme that came out of the quarterly earnings. And so what I'm going to do in this video is I'm going to compare the results with the model that I have on Alibaba. And if you don't have access to that model, you can get access to all my research at this lower tier. And if you want to join us for an epic call, we have one next week Saturday, you can join us at this higher tier. Okay, now let's get into the analysis. And so here's my model for Alibaba. You can see fiscal year 2021, 22, and sort of like what I'm expecting for 2023. And so essentially what I was saying is that I expected total China commerce to decline by approximately 5%. And so their year-to-date outperformance of 1% is effectively outperformance. That's really what's happening there. With international, I was expecting it to only increase by 2.3%. So far, it's on track to increase 8%. Mind you guys, this is just year to date. We'll see where it ends, but it looks like the next quarter is going to be better for total China commerce. It looks like international is going to be better as well. Actually, you know what, international might actually go backwards because Trendyol is in Turkey, and Turkey's been impacted by a natural disaster. And so we'll see how this plays out, but much further ahead than what I expected total international commerce to grow at. And mind you, notice how much of a slowdown I was expecting from 2022. Same with total China commerce. Just 2023 was expected to just be a write-off year, and that's kind of the way I was valuing it. And you can see that here where, in 2022, they grew total revenue at 19%. In 2023, I was expecting them for revenue actually to go back by approximately 2%. So overall, their year-to-date outperformance is 2%. And so, they've definitely outperformed where I expect, or they're outperforming where I expect revenue to be. And of course, we got one more quarter before all is said and done. But once again, I kind of expect that next quarter to not be as strong as what I was originally expecting. Well, that's because there was ongoing lingering impacts of COVID into January and February of this particular quarter. And you can see, of course, that the profitability picture remains the same overall for the segments. China commerce is immensely profitable with a 34% adjusted EBITDA margin. And, you know, cloud is marginally profitable, but essentially the story is that China commerce is supporting all of the other segments. And so just FYI, guys, if you're new to the company, that's kind of been the story for the longest time now. You know, this is the OG segment, and they're trying to grow out new and important businesses. I could expect Cinia to sort of always be at a 0% adjusted EBITDA margin because there's a lot of intercompany stuff going on there, or not. Actually, we'll see how that plays out. And of course, cloud, you want to see the profitability increase substantially as time goes on. You know, the real important thing is just growing out revenues right now, but eventually you do want to see the profitability increase in that segment as well. Now, here's the major takeaway from Daniel Zhang, their CEO's comments in the call. So, you know, the first thing is that China commerce is back. And so he said, with the lifting of COVID-related measures at the end of the peak wave, everything is now quickly getting back on track. So that's good news. That's what I want to hear. You know, logistics have resumed normal operations with the entire supply and manufacturing chains becoming active. And then, of course, the second major takeaway is that we should expect the resumption of the growth in the cloud segment. And so digital transformation across different industries and sectors have accelerated significantly. And so we could expect outperformance in cloud in the next quarter. So we'll see how that plays out. I'm not modeling it in, but of course you can all imagine that if you are modeling in cloud outperformance, your valuation is going to be in that 250 to 300 area, I would assume. But it's not all good news, because you can see that in the March quarter, we'll see impacts due to the recovery only really beginning in mid-February. I kind of expected this, and so no changes are needed in my model as it relates to China commerce. I do expect it to, you know, it might go backwards. Right now it's outperforming. We'll see how it plays out. But once again, I've already modeled fiscal year 2023 to go backwards. I might be a little bit pessimistic, but I don't think I'm too pessimistic there. And so, you know, they said from January to early February of this year, overall sales of online physical goods remained weak, and our China commerce continues to be highly impacted due to COVID cases, as well as people traveling home or to other places during the Spring Festival holidays. And so, as the influence of COVID cases and the Spring Festival travel subsided, they expect this recovery, or they expect the overall recovery to continue. So there's a good news story here. However, the thing that we have to be aware of is that we do expect some weakness, because half of the quarter at least was still impacted by COVID restrictions. And here's how that segment did overall, China commerce. So you can see that revenue as a whole went backwards by 1%, which I showed you earlier. And then recall, guys, from the earlier video that I put out, that customer management actually went back 9%. Direct sales actually increased by 10%. And so what's happening with customer management? Why did it go down by 9%? Well, they tell you right here. Customer management revenue decreased by 9% year over year, primarily due to single mid-digit decline of online physical goods generated on Taobao and Tmall, excluding unpaid orders year to date. So effectively what they're telling you is that sales slowed for Taobao and Tmall. This is something that we were looking forward to. Now, they give two reasons why. The one reason is, you know, there's ongoing, actually they give you a couple of reasons, but the two that I want to talk about here, we already know about the soft consumption demand. The other reason is they're pointing out ongoing competition and of course the logistics disruptions. And so let's talk about those two. The first that I want to talk about is the logistics disruptions, and then I want to talk about ongoing competition. And the logistics disruptions really speak to this soft consumption demand. And so let's get into that. So they recap the whole logistics issue in the conference call by saying, just to recap briefly, the issue of late really has been the high rate of order returns. So remember that, guys, order returns due to, among other things, logistics disruptions, because when we talk about GMV, we're talking about paid GMV, but after the customer has made payments and after logistics and fulfillment, the customer, well, logistics don't work out. And so if logistics doesn't work out, the customers will refund the order. And so that's what they're talking about, of the logistics issues impacting the gross market value. And so here's what they're saying. There's a logistics problem. The consumer will return the goods. So overall, what we're seeing now is, of course, a recovery in logistics and declining return rates. So if you have declining return rates, obviously you expect higher sales overall. And so, this is a good news story, but we do expect some impact from this in the next quarter, so the March quarter. Now, just going into the competition comment. So Charlie was right about competition. Charlie Munger, that is, who spoke about competition with Alibaba and just Chinese online retailers in the last interviews that he's done. And so, he said that competition will be tough in this area, but I think that this was a well-known issue and was a focus of their last investor day, Alibaba's. And that investor day didn't happen in 2022. It happened way back in 2021. And, we did a 10-part series on it where we really covered it and went into depth about, how Alibaba was going to try and be competitive. And so, Charlie Munger did say that, he regards Alibaba as one of the worst mistakes he's ever made. It's going to be a competitive business, the internet, and it's not going to be a cakewalk for everybody. I agree. But once again, this is something that we all knew and we've known it for a long time. And I just want to show you some important pieces of information as it relates to competitiveness in the online retail space in China. Now, you guys know that I have a Wall Street Journal subscription because I always cover Wall Street Journal articles on this channel. But notice that this article came out in June of 2020, right? I think that was well before Charlie Munger bought shares in Alibaba. I think. You guys correct me in the comments if I'm wrong there. But recall that, this article is front and center on the Wall Street Journal in the summer of 2020, highlighting the competitiveness of the Chinese online retail market. So I don't understand how you wouldn't see competitiveness as a risk in the space, especially if you did a SWOT analysis, like I always tell you to do, and, understand who the competitors are and what their spaces are. And so, rivals JD.com and Pinduoduo were gaining on the reigning Chinese commerce king, but they weren't matching its profitability. And so that was the real challenge. And that's one of the reasons why I chose Alibaba out of all the others. And the Wall Street Journal just came out with an article where they're saying that, yeah, Alibaba survived the tech crackdown, but they're warning you that the Chinese e-commerce companies should do better this year, but there's a brewing price war that could spoil the festive mood. Now, this I think is FUD because this has been a thing for many, many years. And so if you're new to Alibaba and you're just seeing this now and you're saying, oh my God, price war, well, they've navigated this before. And so this is what I mean. So this is what the Wall Street Journal is talking about. JD.com just planned a $1.5 billion offensive against Pinduoduo, and effectively what they're doing is that they're going to create a subsidy campaign program to help vendors. So they're going to pay vendors to bring down the cost of products to help customers. Does that sound like a sustainable strategy? And this article came out on February 20th of 2023, and so it's very clear that JD.com talked about it in their last call. And so my question is, is this a sustainable plan, and can you actually go against a company that's got more than $50 billion of just cash available on their balance sheet? You're going to get wrecked if you go in this direction, and that's kind of my interpretation on this. You guys feel free to disagree with me there, but if you want to create a race to the bottom, you're going to lose to the company that's generating cash right now in this environment, and that's Alibaba. And recall, guys, that these subsidy programs are not new. Here's an article from December of 2019. And so, here's where Pinduoduo actually launched a campaign to give around $10 billion, 10 billion RMB in a subsidy program to competitors. And then Alibaba quickly launched one right back. And so, subsidy wars are not new. But what I say is, don't use a subsidy war to attack a company that has more cash than you. And so I just say good luck to anyone that wants to compete with Alibaba using subsidies. It's going to be a race to the bottom for everybody. Alibaba can get hurt as well in this environment, but it just doesn't look like they're using a lot of money right now. The volume or the value of these subsidies are low. But once again, essentially what I'm telling you guys is that this is something that Alibaba has navigated before. They have the experience to deal with it. And so if this is what people are looking at and saying, hey, competition is heating up. Competition has heated up. It's been there for a long time. And so if this is the reason why you're selling the security, I mean, by all means, do what you want to do. It's totally fair. Everyone has their own interpretations. But I think that If this is something new to you, then maybe you just didn't understand the company from the beginning. Now, I might have missed something. I don't know. And so if I have missed something here, if there's something brand new, guys, let me know in the comments and then I'll bring it up in a subsequent video, because I'm not perfect either with my analysis. Now, you know that the analyst community is going to pick up on this and they were going to ask about it. And so one of the first questions was an analyst asking about the subsidy program and, basically trying to get an idea if is this actually a race to the bottom? And so let's take a look at what that analyst asked. So Ronald Kung, I'm sorry if I pronounced that name wrong, said, at what point can we expect to see positive growth returning in the GDP GMV numbers? And also, how are we going to achieve balance between growth and investment in this new year? Because we know that there are people, i.e. JD.com, who are engaging in a lot of subsidization behavior. So how are we going to achieve that balance between growth and investment? And here's the best answer you could give for this. Alibaba just basically gave them an F around and find out answer. So they said, no player has ever managed to achieve that kind of turnaround by relying just on price subsidies. At the end of the day, it's really about merchants being able to provide to consumers the best products at the best prices in a way that's sustainable in the long term. And I absolutely agree. And the other thing is, look, if you want to play this game, we have deep pockets with $55 billion in cash. So F around and find out. And so they're effectively just daring them to do it. The warning has been made. And so, if you guys are wondering why their buybacks are not as high this quarter, this might be one of the reasons why. If they're getting ready for a subsidy battle, you want to have a large balance sheet. Or if you want to make threats like this, that's how you do it. I mean, this is not really a threat, but effectively they're saying we got deep pockets. So effectively we're not worried because we can handle this. And it's not like they're not winning, right? Remember, in their Alibaba Investor Day, they said that they were going to be focusing on growing out Taobao Deals and Taocaicai, and they are winning. Look, Taobao Deals has continued to help an expanding base of manufacturers sell directly to consumers. So this is a shot right at Pinduoduo. And in the December quarter, a paid GMV of manufacturer to consumer products grew more than 35% year over year on Taobao and Taobao Deals. And then, of course, Taocaicai continues to drive category penetration in high purchase frequency categories of groceries and fresh produce on our China retail marketplaces. And so the two areas where they're really going after Pinduoduo, they are doing well. 35% year over year is good. I wish they gave some additional information on Taocaicai. I might have just missed it, but as far as I'm concerned, Taocaicai is also being delivered upon. And so, that is something that I'm going to really focus on once they provide their annual report, which will be subsequent to the next quarter, because it's very interesting. I want to see how they delivered on that relative to what they sort of insinuated that they were going to do in their Investor Day, which is over a year ago now. Okay, I know you're getting sick of me talking about China commerce, and so let's move into international. So you can see here that, international actually grew 18% in the quarter. Blew my expectations out of the water. Year to date, they've grown 8%. So this is nuts. I'm not taking up my international growth rate. At least I don't think I have. And so, I think we're going to see some outperformance here. The other thing is, notice the profitability. So my question is, do we see profitability around the corner? And let's see what they mean about profitability. So they discuss profitability, essentially saying that the decrease in losses year over year was primarily due to reduced losses from Trendyol and Lazada. And so the reduced loss from Trendyol was primarily due to revenue growth and enhanced operating efficiency. Continued narrowing of losses from Lazada was a result of continued improvement in monetization rate by offering more value-added services as well as enhanced operating efficiency. Now, here's why this is important, because Lazada competes with companies like Shopee that are still generating losses. Now, correct me if I'm wrong there, but I'm pretty sure Shopee is still running at huge losses. And so the fact that, they're running at an EBITDA margin of just 4% in the quarter, this speaks volumes. Year to date, it's only 6%. So, I mean, they're really, really doing well here. Now, here's the thing. Notice how they're growing revenue in Turkey. The increase was primarily due to an increase in revenue contributed by Trendyol. The increase in revenue from Trendyol resulted from a robust year-over-year order growth and more efficient use of subsidies. So let's talk about subsidies, right? So the fact that, not only does Alibaba use subsidies in China, but they also use subsidies to grow out internationally. These guys know how this stuff works. They know how to use it, and they know how to use it efficiently. So if their competitors are going to come at them with the use of subsidies, the other thing that you you got to think about is that not every single dollar is utilized in the most effective way. And so, Alibaba has a lot of experience here. And so once again, if you're going to try and compete against Alibaba using subsidies by driving losses in your business, well, they're very well versed operationally on using these as well. And so you still might lose in that environment. And so this is where I say that it's very tough to compete against Alibaba. And you would be right if you said that it's a competitive business and it's not going to be great for everyone. But I would also say that, it's very tough to compete with Alibaba. And at the valuation that the company's currently trading at, it could be a pretty decent bet that the company will outperform the ultimate current value of the cash flows that the company will generate in its life. But who knows how this is going to play out? I might just have my head in the clouds as it relates to the way that I look at Alibaba. Because I'm a shareholder, I have a massive bias, right? But having my head in the clouds is actually a great segue to the next segment that I want to talk about, which is the cloud business. Okay, so overall, you can see that cloud revenue is actually up 3% year over year, much lower than what we want to see cloud growing at. In fact, I would like to see cloud growing at least 15% every year or year over year, every quarter. And so we're just not seeing that. Now, they're telling you that revenue from the non-internet industries actually grew 9% year over year and contributed to the majority of the overall cloud revenue. That's really good. But it looks like, and this is a little bit suspect to me, but it looks like they're still being impacted by TikTok. At least I think this is TikTok, right? So revenues from customers in the internet industry declined 4% year over year, driven mainly by declining revenue from a top internet customer that has gradually stopped using their services overseas for its international business. So that's kind of what I think is going on there. But, I really hope that they can resume growth in the cloud business. Now, they spent a lot of time talking about cloud in the conference call, and I just want to show you a couple of tidbits from that. First, I just want to talk about how they think about cloud overall. So recall, guys, for people who are newer here, the company is focused on growing out e-commerce by being more and more competitive. They're also building out a global cloud platform. So the second part is obviously the cloud focus, but they have two very future focused businesses with internet e-commerce and, global cloud. And so, they're talking about how these are both historic opportunities. And so, both in e-commerce and with cloud computing. And so effectively, they're telling you that this is a two major segment company. And, you already know that e-commerce is so large and so developed already. So, most of the focus to grow out a business segment is the focus to grow out the cloud business segment. So that's how important this is to Alibaba. In fact, their CEO has just made himself the president of the cloud business just to make sure that they deliver on these goals. And from this part in the conference call, you can see that they're looking at the just the cloud business overall as something that's just getting started. So they're saying, just with IT, if you look at the proportion of IT spending within the total GDP of China, it's only 1%. In the US, it's as high as 5%. I don't know if they get to 5%, but they can definitely increase higher than 1%. And so, the proportion of cloud spending within IT spending numbers, this is the real number, right, is 15% in China today, and it can be as high as 21%. So as the overall industry of IT spend grows, the sub-industry of cloud spend in China should be expected to grow out further as well. Also, it's not like the United States is ending at 21. This is going to continue to increase as well. And then there's a couple of areas that represent big opportunities. The first is, generative AI, which they talk about many times, which requires a massive compute power to support them. And so they do expect to see exponential growth in demand for computing power. And let's see how they talk about this a little bit more. So this was from the Q&A. And so, Alicia Yap asked, she said, I'd like to follow up on Daniel's earlier remarks about how Alibaba intends to continue focus on and invest in technological innovation as a means to create new business models and new opportunities for businesses. And so here's where you'll see that they actually talk about a strategy that's very similar to Meta. And so they said the first strategy they have is around artificial intelligence, and lately generative AI has become a hot topic around the world. But we're not talking about having a chatbot. Rather, we're talking about integrating that capability of AI deeply into the business around consumption, around user experience for content generation to drive higher advertising effectiveness. So in other words, to drive sales on their platform. Who's doing that? Meta's doing that as well. And so you can see that they are focused on the same thing, just on different continents, right? Also, when it comes to how to match supply and demand more effectively, how to achieve higher effectiveness in terms of marketing and promotion, and how do we achieve higher efficiency and better use of experience around different services, all of those are places where we can leverage AI to make huge improvements. So I just want to pause there. This first part is not necessarily like a cloud conversation, but I didn't want to put it in this section because the computing power that this AI focus will require them leveraging their cloud expertise in order to get there. Now, I do want to talk about more on their cloud strategy as well, and that's what they get to next in the answering of this question. And so he goes on to say, but beyond that, when we talk about cloud computing and big data, Alibaba has substantial capabilities in terms of providing processing power. There's going to be an exponential growth in demand for computing power to support these kinds of AI applications, and Alibaba is ready to provide precisely that kind of computing power. So here's why I put this in this section, right? And so really what that is, that's a look through for NVIDIA and Taiwan Semiconductor as well, the chip makers, right? I understand that there's certain chips that they can't deliver to Alibaba, but there are certain chips that they can. And so just keep that in mind. The data centers might have to just be larger. I don't know. You guys let me know. I'm not like a super expert. If you guys ever wonder why I'm so humble on this channel, is because I don't know a lot of things, right? I just do the best with what I can understand. And so, they're telling you AI can be leveraged in the ways that we talked about earlier when we talked about supply chains and local services to better match local demand with fulfillment capabilities, local supply in a certain time window, and to make that whole local or neighborhood-based digital commerce scenario run more efficiently. So here's something really cool. And I have not heard about a company in North America talking about this, but you definitely know they're working on it. So AI is now being used at the local logistics level as well. How are they going to do this? I mean, only your imagination can tell. I want you guys to let me know how you would possibly use AI at the local logistics level. Like, I understand that it could probably do real-time route planning and that kind of stuff, but that stuff is stuff we already have. So how else can you use AI at that local level? I'm assuming there's like some supply chain stuff, like understanding what supply you have where in real time, and it can sort of like plan and route all that out. But you guys let me know what you think in terms of how they can better utilize AI for local consumer services. And you know what this really speaks to me is an integration with Eli.me. Now, Eli.me has struggled relative to Meituan. However, does this give Eli.me a competitive advantage against its competitors? We'll wait and see how this plays. And you guys already know that Alibaba really likes to flywheel this stuff, right? One segment can start helping another segment, so on and so forth. So they really like doing that. And so I can really see that happening here. But once again, head might be in the clouds. Now, here's the area that a lot of you guys were a little bit upset about, and I totally get it. Now, I was actually happy that they bought back $3.5 billion of shares, but the fact that they generated approximately $12 billion of free cash flow, you'd think that they'd make more purchases, especially in the quarter where the share price went down so much. There were real opportunities to buy up shares that were severely discounted, and they just didn't do it. And so, the company does now have $55 billion of net cash. And so I think they really need to pick up the share buybacks or redeploy this into the business, i.e. AI and cloud compute. And I think they are going to do that. Part of this might actually be used for subsidies as well. And it might be the reason why they're holding so much on their balance sheet. But ultimately, I'm calculating, using their equity investments as well, I'm calculating something around, north of $40 per share of just cash and investments that they have on their balance sheet. If you take out the equity securities, like that would be like Ant Group and stuff, you might still get to around $25 to $30 per share of just cash and liquid investments on the balance sheet. And so that's how much excess capital I think that they have that's available. And just that $55 billion of cash, could they get rid of 20 billion of that with buybacks? I think they could, but they're not willing to give us an answer on that. And here's what I mean. Sometimes analysts are hesitant to ask the hard questions. So, all credit to Yang Shao, who asked this question. But basically he said, look, in the past quarter, free cash flow exceeded $11 billion. So yeah, it was almost $12 billion. And in the last quarter, you conducted only $3.3 billion of share buybacks under the current buyback program. Are there any other things you can, for example, consider like distributing dividends or further expanding the scale of the buyback program. So effectively, this is a nice way of saying, why didn't you buy back more shares? I know you're probably not going to institute dividends, like they might, who knows, but wouldn't it make a lot of sense to have purchased more shares, especially in that last quarter environment? However, unfortunately, Daniel Zhang did not give us an answer. In fact, he gave us a non-answer, but I think that was expected. I think the point of Yong's question was to send a bit of a warning that the investment committee or community is aware of a lack of action on the buyback front. And I think the company does respond in the next couple of quarters. You know, they spoke about their unused buyback capability and you know, how they're trying to use it. They also spoke about how they increased the availability of shares, or upsizing the availability of shares that can be bought back under the program. And so, you know, I just think the message is loud and clear, and it's something that they will have to address. I hope that buybacks increase, you know, especially now as the share price is now back under $100 per share. I hope that they do exercise their options to buy back more shares, you know, even 6 billion, closer to 10 billion. That would be a real signal to the investment community to not discount the cash that they have. Because here's the thing, here's what happens. If a company just generates cash and then leaves it on their balance sheet, you can do one of two things. You can add that to the valuation for the company and, you know, add it as excess capital, which is what I do. But the other thing that you could do is, if you just assume that this business is in the business of generating cash, but then just leaving it on the balance sheet, and eventually the return on capital, return on equity continues to go lower and lower just because you have all this unused capital on the balance sheet, well, that will actually impact the value of future cash flows that the business generates. You might want to discount them a little bit more, or you might just want to discount what's on the balance sheet. So don't give them as much of an excess cash boost, right? So you can do a couple of things, but ultimately none of this stuff really helps the valuation of the company. And so what they have to do is show us that they're focused not just on building these businesses out, but they're also focused on returning capital to shareholders, or efficiently allocating the capital. It doesn't matter. In fact, you don't want them to buy back dividends. Ultimately, a perfect business would be a business that has ample reinvestment opportunities that generate above market returns, right? If they can invest their capital at 25%, you want them to just keep taking the cash. In fact, you'll give them more cash. And in fact, you'd hope that they take on a little bit of debt even in that situation if the debt's priced low enough. And so, but if the cash is just sitting on the balance sheet, you want them to show that they're good allocators of capital from the perspective of being able to return it to us. So I know a lot of people are upset about that. You know, I'm getting a little bit more weary about that. It's very clear that the investment community is also directly asking them questions about that. And so let's see how they respond. I actually very much believe that this time next quarter, we will see them react to this, and we might see a $10 billion buyback or something. Now, don't, you know, hold me to that. I just think that that's kind of the way that you would want to react to this type of situation. Even if they just take it up to 6 billion, now that the shares are under $100 per share, that could be very accretive to us shareholders. And so let's see how this plays out. Now, guys, I did slightly change the valuation for Alibaba as I've updated my analysis. And if you want access to that valuation, you can get access to that at the lower tier of the Patreon, which gives you access to all my models, including Alibaba, Tencent, and all the rest, Tesla, etc. And if you want to join us next Saturday for an epic live presentation, you can join us at that higher tier. Now, if you missed my first look on Alibaba, I didn't cover everything in this video that I covered in the first look. And so if you missed that first look, you can actually get to that video right here.